All right, well, good afternoon or good morning, as the case may be, whatever time it is for you right now. I know it's a busy time. I know that with legislatures meeting across the country, it's a time where everyone is intensely focused. So I'm very grateful for those of you who've taken some time out, whether you're legislators or staff or others interested in the policy process, to listen to this webinar. And if you are listening later, we thank you for doing that as well. For those of you who are live, there will be a recorded version of this available after the fact so that you can listen later or share it with others who may be interested in some of these topics. We wanted to talk about some things that really are very timely, that are associated with some of the changes economically that we've experienced over the last year or two, and that are relevant to state legislative sessions. Because a lot has changed. We're in an era of high inflation, of significant federal policy uncertainty. On the good side of the ledger, most states are experiencing significant revenue surpluses, and that's wonderful news. But even having lots of money is a challenge, figuring out what to do with that, what the revenue projections look like in the future. And of course, we are struggling with supply chain issues, with labor shortages. It's just a very different time. Some of this directly the consequence of the ongoing pandemic, some of it sort of indirect elements of that, but it has lots of implications for state tax policy. So I'm 𝗵𝗵𝗿𝗲𝗀. I'm Vice President of State Projects at the Tax Foundation, and I'm joined today by my colleague, 𝗵𝗲𝗿𝗲𝗀, who is a Senior Policy Analyst at the Tax Foundation. We will be going back and forth as we talk about some tax reforms that make a lot of sense in the current environment. I'm delighted that she's joining me, not only because she has a lot to say, but because, as you may be able to tell, I don't have much of a voice today. I am proof that there are respiratory illnesses that are not COVID-19 still circulating in the world. But nonetheless, we're excited to be able to talk with you about a number of these issues and just walk through ways that states can try to align their tax codes for the unique circumstances that we're experiencing right now. But also for the future. These are not reforms that are designed just around the COVID-19 pandemic, which we all hope we are on the tail end of now, but are responsive to a very different environment that we now all live in, an environment in which people have much more flexibility about where they live and work. An environment in which we just have very different circumstances in terms of where investment is taking place and what opportunities exist. So we have put together in a paper and the discussion we have today, 8 tax reforms for mobility and modernization. And I want to highlight 2 different ways we should be thinking about the term mobility here. Because there's upward mobility, right? There's the opportunity to improve your lot in life. And there's also outward mobility, the mobility to go and live where you want to live, because increasingly we can live and work in a lot of places, especially many white collar employees. The people that are often very attractive for states, they have a lot of flexibility. They can have their job follow them to wherever they wish, or employers can locate somewhere knowing that they can access a workforce that is across the country or even across the world. And if states interfere with an individual's upward mobility, individuals may increasingly act on that outward geographic mobility. So a very competitive era in state taxation. We saw that last year. 16 states enacted or implemented income tax reductions last year. You have to go back to the follow-up of the Tax Reform Act of 1986, when the tax base at the federal level expanded greatly to have anywhere near that level of response in states on tax cutting. And that's just one area. Income tax reductions are just one of many things that states have done, because you have this high revenue, but you also have a recognition that there's just much more competition now. So income tax cuts, in many cases, were good policy, but we want to talk about things that go beyond the rates. We want to talk about the structural issues that are going to affect states' competitiveness and their fairness and applicability to this new environment going forward. And to start that conversation, I'm going to turn this over to my colleague, 𝗵𝗲𝗿𝗲𝗀, who's going to talk about inflation indexing, because quite clearly, inflation is at levels that we have not seen in many, many years.
Well, thank you, Jared, and thank you all so much for tuning in today. Our first policy recommendation is for states to inflation index their major provisions of their individual income tax codes. So that includes their graduated rate, income tax brackets, standard deductions, personal exemptions, all those major provisions that in many states currently go unindexed. And as Jared mentioned, we've seen major inflation lately, with prices rising by 7% last year, the fastest we've seen in over 40 years. And so now is as good a time as any to make these changes. Because if your state doesn't regularly adjust the major components of its individual income tax code for inflation, then taxpayers are facing unlegislated tax increases every year, where more of their income is not only exposed to higher rates of taxation, but also the value of standard deductions and personal exemptions is eroded over time. And these tax increases, of course, are coming on top of the higher prices consumers are paying for goods and services like food and gasoline and housing. So people are being taxed more, just as they're also paying more for the goods and services they're buying. Currently, 21 states and DC, as you can see on the screen, have room for improvement when it comes to inflation indexing these major income tax provisions. There are currently 15 states and DC that have unindexed individual income tax brackets, and there are even more states that have a standard deduction or personal exemption or dependent personal exemption that isn't indexed. And so many states that already get this right made this change during the 1970s stagflation era, but a lot of states still need to finish the job because a lot of states just haven't tackled this at all. And so now would be a really impactful time to get it right and to make these changes. So even if taxpayers are paying more for their consumption, at least they aren't being taxed more just because of inflation. So most states have worked really hard, over the past decade, especially to make their tax codes more competitive. But if states aren't inflation indexing, they are seeing the competitiveness of their tax provisions erode over time. When it comes to brackets specifically, when inflation causes people to be forced into higher income tax brackets for inflation alone, that's a concept that we refer to as bracket creep, where more of a person's income is subject to higher marginal rates due to nominal increases in wages that might not correspond with real increases in purchasing power. So one way to illustrate this is to look at a state like Delaware, which does not index its brackets. So if you take a single Delaware resident who earned $60,000 in taxable income in 2019 and $64,000 in 2021, this bracket creep would impact them. Due to inflation, that taxpayer wouldn't have actually seen an increase in their real income over time, because $64,000 in 2021 had about the same purchasing power as $60,000 earned in 2019. So in 2019, with $60,000 of taxable income, this taxpayer would have had a top marginal rate of 5.55%, but in 2021, with taxable income of $64,000, but no change in actual purchasing power, that taxpayer would have had $4,000 exposed to that top marginal rate of 6.6%. And then this bracket creep, of course, continues more and more each year as inflation rises over time. And so a good example of how this plays out when it comes to the standard deduction and personal exemption losing value over time is in Kansas, where they've had a single filer standard deduction of $3,000 for over 2 decades. It was $3,000 when it was first enacted in 1988, and it stood that way until 2020. In 2021, they finally increased it by $500, but that still isn't enough to account for inflation, because $3,000 in 1988 is the equivalent of over $7,000 today. So ideally, that deduction would have increased automatically a little each year to keep up with inflation. So this is something that Kansas and other states should look at getting right, especially because Kansas is one of about a dozen states that don't index any of these major provisions. So taxpayers are kind of being hit on all fronts there. And if you are a legislator or a staffer who wants to read more about specific best practices when it comes to how to write legislation that would make some of these important changes, Jared has a really good paper on that topic that you can find on our website. It's entitled Inflation Adjusting State Tax Codes, a primer, and we would encourage you to read that. But I will hand it over to Jared now.
Well, thank you, Catherine. And moving on from that, because clearly inflation is a major issue, but another significant change in how we live and work is the fact that people are much more mobile, as I said, than ever before. And this includes the mobility of people who may have spent several months in another location, or maybe living somewhere that is no longer the state in which their employer is located. But it also just includes the fact that for a very long time, many of us travel sometimes and maybe work while we travel. And the reality is that in many states, working for a single day in another state is sufficient for you to legally have to file and in many cases remit income taxes to that state. And the unfortunate reality is this makes scofflaws of a lot of us, right? I mean, most people, if they check an email while on vacation or visiting family in another state, probably aren't submitting a tax form. And the state doesn't even really want a tax return. They don't want to process something that has no or negligible income tax liability on it. But this isn't how tax provisions should exist. We should have enforceable and laws that we want to be able to enforce. And yet that's not what we have in a lot of states. States should try to reconcile their filing and withholding thresholds to meet the real world of the 21st century. So there has been an effort to get states to adopt a 30-day threshold. And I think that's a very good level to say that you have to be working in a state for 30 days or more for you to have an income tax filing or withholding obligation. Only 12 states meet that standard. Now, if you're counting on the screen, you might see 13. New York is kind of anomalous here. They have a 14-day threshold, and yet there's lots of ways in which functionally they get you on the first day. In fact, they're usually among the most aggressive in this. In most states, theoretically, single dollar of income earned in a state, a single day of work in a state is sufficient. And we need to start thinking about lots of different ways to address these issues. Something that's not directly in the paper, but I think is worth thinking about is the reciprocity agreements a lot of states have. So many states do have agreements with their neighboring states. So if you live in one state, work in another, instead of worrying about paying taxes where you work, getting a credit against your taxes where you live, filing in both places, the states basically say, we've got this, here's the standard, here's the rule, you pay where you live and you're done. 16 states have these rules with each other, the rest don't. This would be a great time for more states to do this. It's a great time for states to raise these thresholds so that employees don't have to tell an employer, hey, look, I'm going to be in another state for a week, especially if they're working remotely, as many people are. I think we all know that many remote employees are not going to inform their employer every time they work remotely from a slightly different location than the one where they receive their paycheck. And yet, theoretically, they must under the current code in most states. Let's fix this. States clearly have an obligation, have a right to collect income taxes when someone is spending a significant amount of time in the state, truly earning income in that state. But some of these are just so incidental. Spending a day or two in a state should not expose you to the full obligation of filing income taxes in another state. And we shouldn't have the capricious and arbitrary enforcement that results in situations where states mostly aren't going after people who have a few days of activity in a state, but maybe doing so in specific cases. So raising these thresholds can make a lot of sense. Also, for remote employees, the convenience rule, which we've talked about in many other forums, is really important. We are down now, thankfully, to 5 states with a convenience of the employer rule. This is after Massachusetts allowed their temporary one to expire, thankfully, and potentially actually allowing that expiration because of the litigation that was going on. But also Arkansas deciding to repeal a convenience rule they had on the books. But these convenience rules, what they basically say is that if you are employed by a company that has its offices in a particular state, then you have an income tax liability in that state, even if that's not where you work. Now, for them to have nexus with you, you must have at least set foot in the state. So maybe you visited the office one day, maybe it's your home office, but nonetheless, you're working somewhere else, you're living somewhere else. And they can try to tax you for the entire year, all of the income that you earned associated with that employer. And of course, you have another state, the one in which you live, that also wants to tax you. Generally speaking, the rule is that if you live in one state and work in another, you pay taxes where you earn the income, and then your domiciliary state will, where your home state, they will provide you a credit for taxes paid to another state. But typically, they are using their own rules to determine what counts as working in another state. So if they aren't a convenience rule state, they won't regard the fact that your office is in New York as being sufficient for you to have worked in New York. They would say, no, it looks in fact like you've been working in Vermont because you live here and you work here. So they may not offer you that credit. During the pandemic, a number of states have been very, very generous about this. New Jersey, to probably a loss of more than $1 billion a year, for instance, has been basically allowing people who live in New Jersey and used to commute into New York, and now we're working remotely in New York, to, when they pay those New York taxes, not have to also pay New Jersey taxes. That's generous of New Jersey, not something I always say about New Jersey on the tax front, but it's also not quite right, and it's not permanent, because the individual lives and works in New Jersey, and eventually that flip gets switched again. And the switch, and then once you do that, you have two states taxing the same income. That's happening for a lot of people across the country. This is, I believe, unconstitutional, and we will see more cases on this. But short of even a federal ruling, states should try to address this. There's no reason why states should be taxing the income of individuals who aren't in their state. And importantly, especially in this highly mobile era, that's going to change where businesses choose to locate. Imagine you are a small firm in New York that maybe has a number of high earners who want to live anywhere. And that's attractive, right? You want to be able to tell your employees, we allow remote work. And if your office is in New York and they're going to be double taxed, that's a pretty strong incentive to move your office, or at least to create a second office somewhere else and make that the employee's home office. So over the longer term, these states are actually driving businesses out for the short-term gain of taxing people who really have next to no connections in the state. That's something that needs to be addressed so that we can have a much more fair, equitable remote work environment for people across the country. And Catherine, I'll turn it back over to you to talk about the handful of states that still have federal deductibility.
Thanks, Jared. So the fourth reform we're recommending is for states to end their state deductions for federal taxes paid, which is known as federal deductibility. And this affects 5 states that you see on the screen. And it helps to think of federal deductibility as kind of the inverse of the federal SALT deduction. So the federal SALT deduction, of course, allows taxpayers to deduct the amount of state and local property taxes plus income or sales taxes paid in a given year up to $10,000 from their federal adjusted gross income. Federal deductibility, meanwhile, allows taxpayers to deduct their federal income taxes from their state income tax forms when calculating their state taxable income. So currently, the 5 states that do this are Alabama, Iowa, Missouri, Montana, and Oregon. Although Iowa is scheduled to repeal federal deductibility in 2023, and Montana is scheduled to repeal it in 2024. So soon it'll just be Alabama, Missouri, and Oregon that continue to do this. Louisiana is a success story on this front. They repealed federal deductibility on both their individual and corporate income taxes last year. Voters agreed to repealing federal deductibility in November 2021 on the ballot in exchange for lower overall individual and corporate income tax rates. So with that repeal, that brought the individual top rate down from 6 to 4.25% and the top corporate rate down from 8 to 7.5% as of this January. And so this is something we would recommend in those other states as well. Now, when states initially adopted federal deductibility years ago, the intention was good. It was seen as a way to try to tax people just on their take-home pay, not on any of their income that was sent to the federal government as federal taxes. But unfortunately, Federal deductibility has done much more to distort tax liability than to actually reduce it. And these distortions come in really surprising and usually undesirable ways. So specifically, under federal deductibility, when someone's federal tax liability goes down, their state income tax liability goes up. So the state ends up penalizing the activities that the federal government is incentivizing. So when the federal government does things to reduce federal tax liability, like increasing child tax credits or research and development credits, those taxpayers won't be able to deduct as much on their state income tax forms as they're used to. And so state liability will go up. And while we're not trying to say that every federal tax benefit or incentive is good policy, it's even worse to disincentivize the things that the federal government is incentivizing. So one example of this is that some of the benefit of contributing to a tax advantage investment account like an IRA is eroded in states that use federal deductibility, because that lowers federal tax liability but increases the amount of income that is taxed by the state. And this impacts individuals and businesses alike, because under the federal tax code, businesses can depreciate assets over time. They can carry forward net operating losses, as we'll talk about in a minute. And so those things can cause a business's federal tax liability to go down from one year to the next. But just as they're getting that federal tax reduction, they will see more state tax liability in the states that use federal deductibility. And then one of the other reasons states should look toward repealing federal deductibility is because it can create a pretty unpredictable situation where tax liability changes for taxpayers, and it can create unstable revenue streams for states. There's really no reason that a federal tax cut should result in an automatic and unlegislated state tax increase. And there's really no reason that a federal tax increase should suddenly deprive states of revenue. Now, it does make sense for states to use a federal tax base as a starting point for their own income tax, but it doesn't make a lot of sense for states to collect more taxes when the federal government is collecting less, and to collect less taxes when the federal government is collecting more. So it's kind of an inverse situation going on here. I'll also point out that there's pretty broad bipartisan consensus that this is a good thing to do, and it's something that could be accomplished even under a divided state government. However, it is true that repealing federal deductibility would result in a net state tax increase. So we are encouraging states to use repealing federal deductibility as an offset for net income tax reductions, as was done in Louisiana last year with bipartisan support. So hopefully we will see that number go down from 5 states to 0 here pretty soon. And then on the next slide, the 5th reform we're recommending is for states to improve their treatment of net operating losses. Businesses experience net operating losses when their tax-deductible expenses exceed their revenues in a given year. And this is especially important right now because a lot of businesses have really struggled during the pandemic, or they've struggled because of the ongoing supply chain issues, and they've had to make unexpected investments. They've had more expenses because of the pandemic. And so in order to stay afloat, they've had more investments, more expenses, and so they might have more net operating losses than normal. But when states have stingy NOL provisions, that can make it a lot more difficult for businesses to recover after an economic downturn. So backing up a bit, NOL deductions exist in the first place because income taxes are designed to be a tax on net profits, so revenues minus total expenses. However, business cycles don't fit neatly into tax years. So for example, a business startup could be unprofitable for many years at the outset, and then when it finally starts making a profit, that might last for a couple of years, and then they might have to suddenly make more investments, and that could cause them to have more net losses for a couple of years. And so that's how a lot of business cycles actually operate. So to address this issue of business profits and losses not fitting neatly into a tax year, the federal government and states allow businesses to carry forward their past losses against future tax liability. And this can help smooth out business net income for tax purposes so that income falls on something a lot closer to a business's true profitability over time. So having a robust NOL deduction is a really important feature, not just in the federal tax code, but in state tax codes. And the more generous the NOL provision is, the more likely that the income tax will actually fall on net income. So before the federal tax reforms of 2017, NOLs could be carried back up to 2 years and could be carried forward up to 20 years at the federal level. The Tax Cuts and Jobs Act modified that, so it eliminated NOL carrybacks, but allows carry forwards to be claimed for an unlimited number of years. However, the amount of losses that can be claimed in any given year, it may not exceed 80% of a taxpayer's tax liability. So NOL carry forwards can't completely wipe out a business's income taxes in a given year, but it can reduce liability to a certain extent. So currently, most states are either conformed to the new federal carry forward provision of unlimited years and an 80% cap, or to the pre-TCJA federal carry forward period of 20 years without a cap. And some states additionally allow NOL carrybacks. So both the new and the old federal provisions are a pretty good standard for states to follow. And we would recommend that at minimum, states match either the new or old federal NOL structure. But there are a number of different states that don't do this well. And so there are 14 states that treat NOLs less generously, as you can see on the slide, with carry forward periods of less than 20 years or with low caps on the amount by which carry forwards can reduce tax liability in a given year. Now, I want to call out California in particular because they actually suspended their NOL carry forward allowance completely for 3 years. That came as a response to fears of revenue loss during the pandemic. California has actually posted pretty extraordinary surpluses, and it sounds like there's consensus that the NOL suspension could be lifted soon, but to date, it's still in place. And this is causing a lot of harm to businesses. And so we would like to see not just California, but all states look at making these provisions more generous, more in line with the federal standard. And one of the main reasons for this is just that failure to provide a robust provision can really reduce business investment. It can discourage entrepreneurship. It can make it difficult for businesses to start up and then make it more likely that they won't be able to get off the ground and that they'll end up failing instead of being able to launch into profitability. And so it's something that could really make a difference for a lot of businesses as we proceed through this economic recovery.
And continuing on, as we think about the different ways the businesses are increasingly mobile, this brings up the issue of throwback rules. And there's a couple of issues I want to emphasize here. For those not familiar with the terminology, throwback rules are not something that a lot of people think about. But when you apportion corporate income, you have sales factor as a major part of this, sometimes the only part of this. Many states have single sales factor, where if you're determining what percentage of a multi-state company's income is apportioned to a particular state for tax purposes, you're just looking at the share of sales into that state as a percentage of sales across the country. Even if you're three-factor, sales is going to be one of the factors along with payroll and property. But sometimes when you're selling into a state, you don't have nexus in the state you're selling into. So you're not falling into their sales factor. And that's typically because of a federal shield, federal legislation from many years ago, PL 86-272, which protects some businesses that sell only tangible property and typically are not really operating in another state, only selling into that state. They don't have automatic nexus in those states. This would apply a lot to a lot of small and mid-sized manufacturers in particular. And you have states with these so-called throwback rules. And what they're saying is, if you're selling from our state to a state that doesn't have nexus over you, that isn't able to tax you, then we're going to tax for two. We're going to tax both on the activity that's associated with our state, and also we're going to tax what that other state would have taxed if they had nexus. The idea of avoiding nowhere income, where you have a portion of a company's income that's not subject to taxation. And you might think, well, yeah, that sounds fair in a way they shouldn't be subject to no taxes elsewhere. But the problem with this, of course, is that it creates a very uncompetitive environment in the home state. Imagine, for instance, that you sell into all 50 states, but you only have nexus with, 20 of them. So now there's 24 other states other than your own that have corporate income taxes, and you selling from the state with a throwback rule means that they're taxing you for your activity there and in 24 other states. They're basically taxing 25 states worth. If you sold out of a state without a throwback rule, you're essentially wiping out the taxes of 24 states on your activity. That's a pretty attractive thing to do. And what we've seen over the years is that states with throwback rules have basically lost the business activity that is associated with firms that would be affected by them. Most companies aren't, but the sort of companies that are have either created arrangements selling out of other states or have shifted facilities to try to address the throwback rule issue. Unfortunately, a lot of states still have them, and it's something that states should look to lift. The economic literature actually suggests that they don't raise money, and that's really, really rare in taxes. You will hear some people who argue that you lose revenue by raising taxes, and that's very rarely true. There are dynamic effects. You don't usually raise the full amount that you hope for because there are going to be behavioral changes associated with taxes. But nonetheless, raising taxes usually raises additional revenue. The literature on throwback rules says that it doesn't work that way, because whatever additional revenue you are raising from the companies that are still operating out of your state and paying additional taxes because of throwback rules is more than offset by the loss of tax revenue from companies that have either shifted part or all of their operations out of state. So you can't just immediately fix this. If you repeal your throwback rule, you're not immediately going to get those companies back. So there is a revenue loss in the short term, even though this should be revenue neutral or better in the long term. What I'd say is that we're in a really good place right now to have some transition costs. States have significant revenue buffers. This is not a significant revenue cost in the short run, and it's probably a benefit, certainly for the state's economy, maybe even for its tax receipts in the long run, to get rid of the throwback rule. And we've seen some states do that. Alabama just repealed its throwback rule. West Virginia repealed a throwout rule, which is very similar. Several other states are looking at this right now to get rid of these really, I think, counterproductive taxes. The flip side of this, though, is that some states are trying to eliminate the nexus issues that create this. Like I said, there's a federal law, PL 86-272, that basically says that if your only activity is sales into a state, then you don't have nexus. There is a multi-state effort right now to read some new ideas into that old federal law, in the same way that before the Wayfair decision on sales taxes, where previously you had to have physical nexus in a state, you got states being creative and saying, well, an online cookie on someone's computer, that's nexus, or clicking through is nexus. We're starting to see the same thing with some states trying to argue and maybe moving forward with the idea that if your website is accessible in their state and has certain content that changes based on geography, or if you're seeking employment, if you've got a job site and it can be accessed from your state, that maybe that creates nexus. I don't believe it actually does under federal law, but states are trying, and throwback rules become less relevant if that's the case. Throwback rules become more relevant if we ever modernize PL 86-272, which is a very old law that only applies to tangible sales. And there have been efforts in Congress, and probably will continue to be, to modernize this to make it a broader protection for companies that really don't have activity in another state. So depending on where this goes with states and the federal government, this either becomes less or more of an issue. It's hard to predict where, although I think that in the short run, states are trying to erode the nexus limitations. That's bad policy, by the way. But regardless of where it goes, it makes sense for states not to stand in the way of having businesses locate in their states. You do not want to penalize businesses choosing to locate in your state over another state, and that's what throwback rules are doing. And much the same thing is happening with capital stock taxes. These are, at this point, very much a Southern tax, a Southeastern states tax, not exclusively, but you can see that map. You can see where these still predominate. Capital stock taxes, they're often called franchise taxes, but we don't usually use that term because states sometimes use the term franchise tax for completely different types of taxes. Texas has a gross receipts tax that they call a franchise tax. Tennessee has a capital stock tax, but they have other things that come under franchise and excise. So the term we're careful with, we're referring to taxes on basically the net worth of a firm or on the value of its assets. This is therefore an investment tax, and fundamentally, you get less of whatever you tax. And this is why states are usually fairly careful about how they choose to tax businesses, not whether they tax businesses, certainly, but what aspects you're taxing. And of course, we know that states often provide investment tax credits. The federal government provides investment tax credits. These are often poorly designed policies, but there's a recognition that you want investment. It's something you want to encourage. Capital stock taxes are the opposite of this. They are taxes that are levied without regard to ability to pay, without regard to profitability. You can be losing money. You can be a startup that just doesn't have any net income yet. You are subject to capital stock taxes. The more you invest, the more assets you have, the heavier the tax is. This is just the opposite of all the principles that you typically see in business taxation. And especially now, where businesses have greater flexibility on where they locate, these things are a significant concern. They've historically fallen pretty heavily on capital-intensive businesses, manufacturing, some of the more heavy processes, but they also hit any business that is low margin and therefore doesn't have a lot of profits compared to its assets, or is just starting out. So if you are trying to attract new businesses, if you're trying to capitalize on migration right now, these are a good way to penalize your new businesses and your business startups. States have been trying to get rid of them. Mississippi's phasing its out. Connecticut is phasing its out. Illinois is supposedly that they suspended it for a year, but will hopefully continue to phase out. New York had been phasing its out. It was getting very close. It had 1 year to go. Last year, it was supposed to be gone. And in the budget, belatedly, they restored it, claiming poverty because of the pandemic. We, of course, know that New York had significant surpluses. One would hope that they can get this back on the agenda. But right now, they phased it down substantially, but they've locked it in with the rate that they had. Other states, though, recently, in recent years, West Virginia, Rhode Island, a variety of other states have eliminated these. Broadly, there's been a consensus that these are bad taxes, they're on the wrong base, and that they're something that states should be taking care of. And related to that, also in the sense of taxing investment, taxing property, taxing assets rather than taxing income or flows. I'll turn it back over to Catherine to talk about inventory taxes.
Yeah, so this is the final recommendation we want to list today, but inventory taxes are something that states should work toward repealing. So this is a tax that's levied. It's a type of property tax levied on the value of the inventory that a business keeps in stock to sell. So believe it or not, there are 14 states that still do this. As you can see on the screen, there's 9 states that fully tax business inventory and 5 that partially tax it. And these are clearly quite burdensome to certain types of industries. So retailers, manufacturers, businesses that have no choice but to keep a lot of inventory in stock. Those are the businesses that are most harmed by these taxes. But you can see how this tax would be very non-neutral in that if you're more service-oriented as a business, you don't have as much inventory, and so you're not paying as much in inventory taxes. You may be using just as many government services as the retailer or manufacturer that has really high inventory tax burdens, but you're not paying this tax. So it's non-neutral. It's something that definitely penalizes investment and penalizes locating inventory in certain states. And because of that, it's highly distortionary. It creates a really strong incentive for businesses to locate their inventory outside of states that have these taxes. Now, some businesses can do this more than others. Maybe multi-state businesses can do this a lot better, or very large businesses. But for others, it's extremely burdensome. And that also exacerbates a lot of the supply chain issues we're seeing right now, where supply chains are already strained. So the last thing we need is a tax that's creating an incentive to keep inventory out of state, to make business processes less efficient than they would be otherwise. And so at this point, you might be wondering, why are there 14 states that still do this? And one of the reasons is that as a type of property tax, inventory tax revenue primarily goes to local governments rather than the state. And so states are rightly concerned that flat out repealing the inventory tax would result in revenue losses to local governments, and some local governments would be more heavily impacted than others because they rely more heavily on this tax than others. They have more businesses that are subject to this tax. And so one possible solution here is for the state to repeal the inventory tax, but to compensate local governments for the lost revenue. So increasing their formulary aid based on perhaps the amount of inventory tax revenue they're generating currently, something like that would be a viable solution. Now, a lot of states, and Kentucky in particular is one state that has responded trying to address the inventory tax by creating an inventory tax credit to offset the burden of the inventory taxes actually paid. But that's not actually quite as good of a solution for a number of reasons. It's better than nothing, but it has a lot of shortcomings. For one thing, if it's an income tax credit that's being provided and it's non-refundable, a business may not post profits in a given year, and so it could have substantial inventory tax liability, but not be able to claim an offset because it doesn't have net income tax liability. Another possibility is that unless states design really adequate protections to prevent this, local governments could have an incentive to increase their inventory taxes, knowing that the state will offset that liability to taxpayers at the state level. And so they'll be reimbursed by the state anyway. That could create some distorted incentives. You could also envision a situation where if businesses know they're going to get a credit from the state, they might not be quite as careful in calculating their inventory tax liability. They might accidentally overpay to local governments, knowing that if they accidentally do overpay, at least they'll be reimbursed by the state. And so this does create some inefficiencies. But the most important reason is just because inventory tax liability is burdensome for businesses to comply with, and it's also an administrative burden for the state. And so having the tax on the books and then having a credit may reduce liability for businesses, but it doesn't reduce the deadweight loss of having a tax on the books that businesses still have to comply with and the government still has to administer. So we would strongly recommend actually repealing this tax instead of just trying to use a credit. So now I will hand it back over to Jared to kind of wrap things up before we open it up for Q&A.
Thank you, Catherine, and thank you everyone who's been on the call. And we've, of course, only scratched the surface of the issues that states will be taking up this year and in the coming years, and only really even scratched the surface of issues that really directly arise from the changes in the mobility that people have and the modernization of the tax code that we'll need to follow. Other things that just, policymakers need to be thinking about at the state and local level. Commercial property is dramatically changing. So, you think about not only the values of commercial property and what that's going to do as they're reassessed, but how that value is calculated. Take, for instance, in many cases, commercial property is valued based on the use, in a sense, and the income producing potential of it. Now, if a lot of your workers are remote, are they responsible for the income produced by that company or not? Think about sourcing of service income for the corporate income tax when some of these services are being performed by remote employees. Where does that get sourced? Or for sales tax look-through purposes, ideally the sales tax would be a tax on personal consumption. That's what it's supposed to be, but we all know that some business services get taxed, and sometimes some states have look-throughs and they look look at, where the services are consumed by the business, not just where its billing address is, but you subscribe to a service, where are all their offices, and you allocate it that way. Well, what if it's not just offices anymore? What if it's thousands of homes? How do you handle all of these issues? So there's going to be a lot of complexity that states and localities are going to have to deal with in the coming years. We wanted to give you at least an overview of some important tax policies that address and respond to increased mobility and competitiveness, and help states modernize to look at inflation, to look at the supply chain, to look at the change in remote work, what should be on the table. We've got a couple of questions that are coming in, but as we start to take those, I would encourage you, if you have a question and you haven't asked it yet, there is a Q&A box in Zoom, so please feel free to ask your question. I'm going to start by just taking a question about what happens if states eliminate some of the taxes that we recommended. Should taxes be raised? Which taxes potentially should be raised to avoid revenue losses? And maybe a two-part answer to that, because one, some taxes are much more neutral than others. Many sales taxes are relatively narrow in their base. They're not capturing a lot of the modern economy. So when we talk about modernization, part of that is capturing forms of consumption that didn't exist when sales taxes were created, which is important for, in some ways, the progressivity of a sales tax. Higher income earners tend to consume more personal services. That's often not fully captured in a sales tax base. Digital goods, for instance, often aren't in there. Personal services are often excluded. There's a revenue raising option that increases the neutrality of the tax code. And if that's an offset for reducing liability in ways to distort the economy, that's great. There are other things you can do along those lines too. But I would also point out, Nebraska's tax revenue grew about 11% year over year. That's the worst in the entire country. Last year is 10.8% growth. We saw double-digit revenue growth in every single state. I think the average was about 20%. And you say, oh no, that's against the 2020 baseline, and 2020 was a rough year. Actually, not really. State revenues are flat, basically, between 2019 and 2020. Tax revenues are up about 20% over where they were in 2019. And even once you account for inflation, this is some of the most rapid growth that we've seen in a very long time. So states are running significant surpluses, and they're not doing this because they cut their budgets. They didn't. They're doing this because tax revenues are high, and they're projected to remain high. This has been one of the really interesting things, that not only do we get maybe a temporary juicing of the economy with all of the federal aid and with all of the federal spending, injecting that into the economy, but revenue forecasters in states across the country are saying that they are seeing upward trajectories of revenue for years into the future. We're talking many billions of dollars in many states. So there's really an opportunity to reform taxes, even cut taxes out of growth. And that's what we saw last year with 16 states cutting income taxes. Every single one of those did it by returning a portion, sometimes a significant portion, sometimes a modest portion, but a portion of their growth to the taxpayers. They didn't cut government. This wasn't a cut. This was a decision not to grow it as much as it could have. And most of the states that are looking at tax reforms now are doing the same thing. So some of the reforms we talked about in this really don't lose much revenue, or are about foregoing some revenue that they could have, but don't currently have. A few of them would have costs, but this is a really good time to be able to absorb those costs, to be able to generate greater economic activity, across the board. Another question dealt with business inventory taxes, asking if it's different than a personal property tax. And it's type. It's a type of personal property tax, but it's a narrow type. Most states tax tangible personal property, but it's rare to be taxing the inventory portion. And the reason I take this rather than handing over to Catherine is I'm a Virginian who has worked in Virginia in the past, and the question asked, does Virginia have a business inventory tax? Because the questioner knows they have a personal property tax. And yes, Virginia has both what they call the machinery and tools tax, which is the personal property tax, and a merchant's capital tax, which is the business inventory tax. In most states, you don't have unique names like that. It's just a personal property tax that includes inventory. But that is very much an issue out there. Let's see what else we have coming in. How much of a concern is the link between payroll tax liability in a particular state and the corporate income tax nexus? So there is a distinction here. Having employees in a state often does create nexus. And so suddenly businesses have nexus in a lot of states that they didn't previously have nexus in. This is an issue for corporate income tax purposes, not only because now if there's a payroll factor, you've got that, but more importantly, that everything that might have been out previously because of lack of nexus is potentially in. So think again of the sourcing of service income. Let's say that you have a service-oriented business and you are selling services to clients. Historically, maybe you did that in an office in a state that has destination sourcing on services. It's instead of being on where the income is produced, it's on where the benefit of services is retrieved. So you pay taxes in the state where your clients are and not in the state where your employees are. Now, some of your employees are maybe in a state where they do cost of performance or income producing activity. You're potentially having income sourced to that state and another state on the same income or the same transaction. We want to avoid that sort of double taxation. And of course, states that do still tax based on income producing activity, if they source that way, they're making themselves very unattractive for allowing remote work. And you're going to see more and more companies as the pandemic lifts say, listen, there are some states you just can't operate out of because it's going to expose us to additional taxation. Another question, will I get in trouble if I sent an email on vacation from some state and didn't file a return there? Practical answer, no. I mean, realistically, states are not on top of that and don't really care because functionally you probably owe nothing and they don't want to deal with that. If you happen, and I doubt this is true of our questioner, but if you happen to be the CEO of a Fortune 500 company, they might actually care about that email because you might in that day have earned enough income that you can be taxable. But the reality is you shouldn't be technically out of compliance in the tax code because you checked your email while on vacation. And tax codes should have sufficient thresholds to protect against that. Let's see. What percentage of state revenues is sales taxes on average? And a question about Wayfair keeping revenues high. And Catherine, I don't know if you have a better recollection of this. Sales taxes, I think, are ballpark 30% of state tax collections, but of course it's going to vary substantially from state to state. I don't know if you have anything you can add on that.
Yeah, it's about 30% last I checked. It tends to be a smaller share of the total state and local revenue than income taxes. So right now, states tend to get most of their revenue from income taxes, a little bit less from sales taxes.
Yeah, and Wayfair certainly has the decision to allow it to be easier to collect from remote sellers. That has certainly boosted sales tax revenue across the country. Another thing that has affected sales tax revenue is a change in the last couple of years of what we purchase. Like I said, services are typically out of most sales tax bases. A lot of experiences functionally aren't taxed. We've purchased fewer experiences over the last couple of years as a country. Instead we've purchased a lot more tangible goods. You've seen people deciding to finally do those renovations, to get that bigger TV, to have a lot more consumption of goods, and that has actually increased sales tax collections in a way that's presumably not sustainable as we get back to normal. And sales taxes on a whole have been losing their place because the sales tax base has been eroding. It's been allowed to erode both because things outside of the traditional base are more and more of how we consume and because of intentional choices of lawmakers to chip away at that base. So we've sort of undone the balance between income and sales taxes, and especially since sales taxes are usually considered a less economically harmful tax. That's a concern. Income taxes are often deemed as more progressive. Sales taxes are deemed less economically harmful. And most states have struck a balance, and they've made that choice to have both and to balance them so that they try to get the best and worst of both of them. But we're getting out of balance on a lot of that. Question about the distinction between throwback and throwout rules. And I didn't really go into any detail of the technical specifications of how throwback and throwout rules work. So let me just spend a quick minute on that. Basically, with a throwback rule, you're saying, you've got a sales factor, right? And you've got a numerator of the sales factor, which is the sales in state A. And the denominator of the sales factor is the sales in the whole country. So that gives you a ratio of what percentage of sales. Under a throwback rule, if you have sales in state B and they're not taxable, they're not, they don't have nexus there, you add those to the numerator. So now it's sales in state A and B with the denominator of all sales. With a throwout rule, it's not as bad. You're saying that state B's sales are excluded from the denominator. So it's state A sales over a denominator of all sales except state B's sales. So in both cases, that increases the taxability in the state in which you're selling from. But the throwback rule does more in that regard than the throwout rule does. Let's see. I see a question about a 4% surcharge in Massachusetts. So there's been a discussion there of not having a flat tax anymore, having a graduated rate tax with a top rate of 9%, plus the payroll tax that was imposed last year, which would basically mean, I think, about a 9.6% tax and previously they had a 5% tax. This is one of the rare examples right now where there's consideration of tax increases. Last year, like I said, 16 states cut income taxes, 2 states, well, 1 state and the District of Columbia raised them, New York and DC. This year, Massachusetts is looking on the ballot at raising taxes, and I think that's the only state that I have seen looking at an income tax increase. This year, we've seen many states looking at income tax cuts. So that'd be a little anomalous and certainly put the state out of keeping with its peers, something to keep an eye on. And we organizationally will be weighing in on that over the coming year, because that is a ballot measure. We received a number of other questions. I know that we've got to wrap up. But do we just have a number of questions? Well, we've got a question about whether the convenience rule violates the due process and commerce clauses of the Constitution. I've written a paper arguing yes. I very much believe that the answer is yes to that. The courts have not actually ever taken that up. Federal courts have not taken that up on the merits. A New York court has twice said that New York's laws are okay. I think they're wrong. A federal court has not yet taken the case up. We had hoped that maybe the Supreme Court would allow a petition to come forward from New Hampshire against Massachusetts. Obviously, a state litigating this makes a big difference. They have original jurisdiction with the U.S. Supreme Court. But there were 2 reasons the Supreme Court cited in not taking that case up. One was that Massachusetts tax was temporary, so the problem was going away. They didn't feel like they needed to address it. And the second was that New Hampshire maybe had a lesser claim of harm, because the harm for New Hampshire would have been its residents who paid Massachusetts taxes, even though they weren't working in Massachusetts. But also the harm typically to a state is its impact on the state's own revenue capacity. In most states, this means either you're double taxing your residents, bad, or you're foregoing revenue that you're allowed to have. New Hampshire doesn't have an individual income tax, and the court seemed to think that that made their case less relevant. I would hope that this case could be taken up, maybe New Jersey versus New York, or one of those others, Connecticut potentially, others that have expressed significant opposition. We will see. I think it's unconstitutional, but I also know that federal courts are pretty reticent about litigating these questions in the states. Nonetheless, it's appropriate because it is an area where states are in direct conflict with each other. They're taxing each other's residents on the same sources of income. It's an appropriate matter to be brought up in this context and decided by the courts. We are to the end of the hour, and I know how busy people are during legislative sessions, so I want to acknowledge that and to wrap up in a timely manner. We are very grateful for everyone who tuned in. Again, this will be available as a recording as well, so if you didn't have a chance to catch all of it, or if you know others who might be interested, please, we will be sending around the link and it'll be on our website. Please share that with anyone who might be interested. Take a look at the paper, and of course, reach out to us if any of these reforms are of interest to you. If there are concerns that have been raised here and you think my state can be doing better, or I need to understand how to do this, our email addresses are on the screen. We would love to hear from you. We'd love to help you in any way we can. So thanks again for tuning in during a very busy time of year. We appreciate it and look forward to hopefully talking to many of you soon. Thank you.